if you don't understand the metrics that go into how you analyze properties, you may or may not be getting a good deal. And this really changed my investment strategy. It changed my philosophy, and it changed the direction of my investment career once I started understanding how to analyze and how to measure good investment properties. Hi, my name is Matt, and this channel is dedicated to helping you become financially independent through real estate investing. What I'm going to talk about today is how to look for and analyze investment properties, and how to know if it's really a good investment, a bad investment, and how to weigh it against all the other investment opportunities that you have. Now, when judging pieces of property and different pieces of real estate, you want to judge it as an investment. You want to make sure that this investment really is going to yield you the best return against all the other asset classes that you could possibly invest in. You can invest in bonds, you can invest in stocks, you can invest in private businesses, and you want to make sure you're going to put your money here with this investment is going to earn you a better return than all the other alternatives out there. Otherwise, you might as well put your money into the stock market or the bond market, where you truly can become passive and not have to work for your money, and over a long period of time, know that if the money's in the stock market, you'll probably earn about a 7 to 10% return. So if you know that's the alternative, you want to look at your real estate investment to earn a better return than those alternatives. Now, I'm here in Los Angeles, a high cost of living area, and I see a lot of people purchasing properties just because historically values have really gone up over time here in Southern California. And they're saying, hey, I'm going to purchase this property regardless of if it provides me a lot of cash flow, and hopefully I make a good return over time because the value is going to go up. This is absolutely not how I invest. I want to analyze a property and make sure that it's going to give me a good return every single month, month in and month out. And at the end of the day, it will, if I hold it long enough, it will end up going up in value along with every other property out there that's going up in value. Sure, there are going to be down markets, there are going to be up markets, but if I hold it for 10 or 15 years, I'm pretty confident that this property is going to appreciate in value. But in the meantime, while holding the property, I want to make sure it gives me a certain return for all the work and the energy I'm putting into it. Every property out there is going to require some form of maintenance. Maybe the toilet's going to back up at some point in time, or the tub's going to stop draining so well. Many properties here in Los Angeles were built in the 1950s or earlier, and those properties just simply require maintenance. You know, the roofs are going to go bad at periods of time. The AC system's going to need upgrading. And you don't want to own a property and rent it out with very thin cash flow when you're going to have all those maintenance calls. You know, if a tenant calls you up and says, hey, the AC hasn't worked and we're getting into summertime and now you have a $5,000 expense, that's going to be really painful when you've only been clearing a couple $100s a month for 2 or 3 years. You know, that's going to wipe out 2 or 3 years worth of that profit if you have to go and replace an AC system. So I'm going to show you how I look for properties, what I do once I find the properties, and how I would analyze those properties to really make sure that it's giving me a better than stock market return, so that it's worth my time, it's worth my thought capital and my time and energy to own and manage this property. The way I start out looking for properties is I say, hey, will the income I generate from it give me about 1% of the overall costs that I'm going to have into the property? So what that means is that if the overall cost of the property is about $800,000 or $900,000, I want to be generating $8,000 or $9,000 a month in rent from that property. Now that might sound really difficult here in California, as a lot of single family homes are $1 million plus. The neighborhood I live in, you cannot buy a single family home for less than $1 million. I'm here in the South Bay, and it's really difficult to find any property, any single family home for less than $1 million. So I'm not looking for properties here in this direct area. I can drive 20 minutes into LA a little bit, and I can find properties at a much better discount. So I start off looking, in different neighborhoods than where I'm initially living. And then what I'm doing once I buy the property oftentimes is I'm building additional units. I'm building ADUs, I'm building second units. I'm looking at what the zoning is on the property. and I'm changing the unit structure to get myself a better return. So to kind of start off with, what I'm doing is I'm going here and I'm filtering for a number of different things. In this search right here, I'm searching for properties that are less than $500,000 on lots that are over 6,000 square feet. So what that means is that if there's a lot over 6,000 square feet, I should be able to build additional units. Some of these areas I know that I've had success with. I've done some properties down here in Wilmington and Long Beach. I've done some properties a little bit north up in the valley. Inglewood is an area that really has exploded in value, so it's really unusual to see a property over here in Inglewood at $449. So this kind of stands out right away. And I click on this property here, and let's take a look at this here. Let's see, looks like it's a real fixer-upper. I have no idea really what's going to be wrong with the property. You can expect to probably have to change the roof. Possibly there's even going to be foundation issues with a property that looks like this. And you can understand right away why this is being listed at $449 here in Inglewood. And so this is going to be a major fixer right from the start. And you can see here that the lot is 6,200 square feet. So that's good. The lot's 6,200 square feet. I do like that. The house is a little bit small. It says 3 bedrooms. I don't know how you can get 3 bedrooms into an 895 square foot house. Maybe they took the dining room and converted it into a bedroom or something like that. But it seems like 895 wouldn't really fit a 3-bedroom house. But maybe it does actually have 3 bedrooms. I don't know. So this is a very initial analysis of the house, just kind of seeing the raw stats on it. How big the lot is, how big the house is, how many bedrooms it has. I question if it could really have 3 bedrooms if the house is only 895 square feet, but maybe it does. I don't know. So they're asking about $450 for it. Another thing I would do after I look at the property, before I ever even call up the real estate agent, or before I ever decide I'm going to go out there and look at the property, is I want to take a look at the street just to get an idea of what is the neighborhood like. And something that you can always look for is what kind of cars are on the street. If you have decent looking cars, you know that the neighbors are kind of well off, or if the lawns are well taken care of, you can get an idea of how the general neighborhood is kind of taking care of their properties. This looks pretty decent. I mean, these people have kind of an interesting yard with really high hedges right here. I often see that in kind of high-end neighborhoods even. And you can tell right away, this property is the property that they're selling for $450. And some of these other properties look really interesting. I mean, you have this somewhat new development right over here. This has to be 2 units. I mean, I'm sure this is probably the back unit right here and the front unit right here. Looks like that was built sometime in the past 10 years, maybe 15. And all around, I would say this street looks pretty nice. I mean, you got decent cars. I don't see a whole lot of graffiti or anything like that. Sometimes that's just a red flag. I mean, I can't tell you how many streets I've looked at and you do the street view and you see some wall that is all tagged up by gangbangers or something like that. And when I see that, I just want to stay away from that house. It's not a house I want to invest in. But this house looks good from a street point of view. I know I like Inglewood. And at this point, maybe I would do a little bit further analysis into this property. Now, I mentioned the 1% rule as a way of starting out to look at properties. So what that means is that I want to look at my overall cost in this property. Now, I like building additional units. So I know I can build an ADU and a second unit per SB9. And I know I can pretty much do that for about $300,000. That's how much I've been able to do it with my contractor. So 2 additional units. I'm probably going to be into this property easily for $100,000. Just looking at the condition from this one picture that they have on it, or the front picture of the home and the one picture they have in the interior. So that's about $400,000 I'm going to put into the house. And if I did purchase it at the asking price, that's $850. Now, I think on a 3-bedroom home, I can probably get about $2,900 in rent in Inglewood. And if I did the second unit and the ADU also at 3 bedrooms, we're looking at all around 3 units that are collecting $2,900. So let's just round it up and say 3,000 times 3, that's 9,000. Roughly speaking, this would meet that 1% rule. So this house would warrant to take the further deeper analysis into it. So what I put together is my real estate investment calculator, and you can download this. I'm making this available to anybody that wants to have this, and you can go and download this and put your own numbers into this for any property that you're analyzing. And what this does is this can analyze if you're gonna put additional units on a property, or if you're just purchasing a property and plan to hold on to it without putting any additional units on it. And I'm going to show you here how I use this and all the numbers that you need to know to determine if this is a good investment. Remember, a good investment is only a good investment if it's better than the other alternative investments you can put your money into. So this property here, they were asking $450,000 roughly. I mean, it said $449, but for all intents and purposes is $450. Let's say your closing costs are $5,000, and that property probably needs more than $50,000 of repairs. I'm going to estimate it at $115,000. That's just from very, very quick look of one picture. I imagine it needs a roof, probably structural repairs, drywall all over, new windows. There's going to be a lot that is going to have to be done to that house to get it up to a rental condition. And then the construction of the units I mentioned for about $300,000. So all in, we're in it for $888 if these numbers are going to hold. So let's find out here. We'll keep on going over here. So in this calculator here, often when you're building additional units, you use what's called a bridge loan. That's a loan that you basically bridges you from the construction period to the point in time when all the units are built, and then you can refinance out of it. So let's say with this bridge loan, they might require more than 20% down payment, because investor loans typically they're a little bit different, a little higher interest rate, cost a little bit more than a typical conventional loan from a bank. But that's the purpose, is you keep it for a year, you keep it for some period of time while you're going through the construction process. So let's say we put 30% down, say it costs us 2 points, and let's say they're going to give us a 9% interest rate, interest only, because that's how most investment, hard money, private money, bridge loans work, is it's just an interest only payment that you're paying. And moving on over here, the after construction assumptions, we're saying, okay, the permits and the construction is going to take us 10 months. We can even adjust that, say 11 months or 12 months, 13 months, however many months you think it's going to take you to get through the permits and the construction. And the after construction value, I'd say 3 units with 2 units and an ADU in Inglewood. Most likely, I think a bank would appraise that at probably 1.1. Got to add one more 1 there, or one more 0. And the annual appreciation rate, let's say 2% on average. Sometimes people will argue that California goes up more than that, but I think 2% is pretty safe. And the after construction assessed value. This is important because if we purchase the property at $450,000, but we put 2 more units onto it, a year or 2 down the road, Inglewood is going to be saying, hey, we know that you put 2 more units on it, that property is no longer worth $450. We're going to put a value at, let's say, $850. Typically, they don't go as high as the actual appraised value, but that's what I've seen, is they'll add a few $100,000 for the units. And goods and service inflation rate. So this is our expenses are going up at about 2% per year. We're a little bit higher on inflation right now, but I don't think that's going to hold, forever. And let's just say the estimated value is the same as what the bank says. Sometimes the reason I put this cell in here is because I've used banks that give me really good loans, but they go really conservative on the appraisal and on the value. So if you know that the bank is putting, is going to appraise your value at 1.1, but you know that you can turn around right away and basically sell it at 1.2. You might as well just say that the value is 1.2 right here, even though the bank is putting the value at 1.1 right here. So after you build the units, the bank is going to give you a certain percentage of the value. Let's say they give you 70% of the appraised value. And what I typically do, since I'm holding these for the long term, is I want the lowest interest rate possible. So I'm going to buy down the interest rate. That means I get a lower interest rate by paying a little bit of fees up front. So that's why I'm putting 2% right here for points to acquire the loan. I'd rather have a low interest rate going forward into the future and pay a little bit for it now. So it costs me a little bit of money and it gets me a better interest rate in the future. And we do actually still have banks that are lending us money after we buy the rate down. I'm just going to say 4.25%. So the loan amount is going to be $748 if they're giving us at 70% of the value. I tend to do interest-only loans. I know some people are, set in their ways and say I have to amortize, and I want to amortize it over 30. But I tend to do interest-only loans because it's going to really improve the financial metrics on your cash on cash return, and so many other things are actually better if you do an interest-only loan. Also, the reason I do interest-only is the majority of your growth is going to come from appreciation. When you really run the numbers, in the first 10 years of having any loan, you're paying it down very, very slowly. But if you have $1 million property or $1.1 million, and you're getting even just 2% growth per year, you're getting over $20,000 a year in appreciation, but you're not paying down your loan $20,000 per year. So I'd rather take that money that would be going towards my principal, take it out and then reinvest it in other investments rather than paying something down at 4 or 5%. I can do better with my money than 4 or 5%, so I don't see a point in paying that loan down. Over here on the rental assumptions, I said I think I can get about $2,900 for a 3-bedroom, and let's say that property is in really bad condition. Let's say it takes me 5 months to actually fix it up and get that property rented out. And then if we said that it's going to take us 11 months to build this, let's say then it takes us 12 months to get the back units rented out. Unit 2 and the ADU. Let's say it takes us 12 months. Let's say everything's going to be $2,900. And we're going on down here. The initial cash outlay for the property would be $591,000. That's what it's going to take us for the down payment. That's what it's going to take us for the closing costs and the points for the loan. That's what it's going to take us to pay the loan while we're doing the construction, and the $300,000 and the $115,000 to build the additional units and fix up the main house. That's the initial cash outlay. Now, if we now reappraise the house after the construction is done and we take out some cash up to 70% of the value of the property, we can actually take out $433,000. That leaves a total investment in the property of $158,000, and that gives us additional equity above and beyond what it costs us to build the units. It gives us additional equity of $235,000 if we're estimating the properties at 1.1 and our total cost in the property is $897. That's where you have a $235,000 built-in equity that we built there. So we have a vacancy rate that we always estimate at 5%. That means that in any given year, 5% of the units are going to be vacant. So, of 3 units, that's about 1 month where you have to, fill, somebody might move out and you have to spend a month getting it rented out. So this helps you project into the future how much you're actually going to be collecting. In year 1, remember, we're only collecting rent from the tenant that is in the main house. And then after that, we start collecting much more rent because we have the other units built. Now with this sheet, you can edit it to your own numbers, but you only want to change the numbers that are in red. The numbers that are in black will auto-calculate, but you can change any of the numbers that are in red to analyze your own properties. Now as we scroll down here, and we're going to be estimating the expenses, You gotta, of course, think about property taxes. We're estimated at about 1% of the property value, and this is why we ask the assessed value, because in years 1 and 2, they're going to be taxing you on the assessed value of what you purchased it at, or kind of in that range. So 1% of 450,000 is 4,500. Then they're going to assess the value higher because you built the additional units, and you have a higher tax going forward. Insurance, you can roughly estimate that, but for 3 units, I'd say you're going to be paying about $3,000 per year. Maintenance and repairs, $4,000. I think that is fair per year. It could be $3,000 since you built 2 of the units are brand new. So let's say $3,000. Owner paid utilities. If you're going to be paying water or electricity or anything like that, you got to account for the utilities. A lot of times we do end up paying the water. We separate the electricity, but we keep the water all on 1 meter. And with 3 units, I'd say you're easily doing a $500 monthly water bill, which comes to $6,000 per year. Property management, we don't pay for property management, but you can put that in there if you're going to be paying a property manager. Mortgage insurance, for instance, if you purchase this with an FHA loan and you're required to have that. A capital expense reserve. Now what this is really important to think about. You don't have capital expenses necessarily every year, but the capital expenses are really going to hit you when they come. Those are things like roofs, driveways, AC systems. They're oftentimes several $1,000 expenses, and if you're not putting a little bit of money aside every year to pay for them, then it's really going to cause a loss in a year when that roof needs to be replaced or that AC system is failing you. So we're looking here at total expenses kind of in the range of $20,000, a little bit over $20,000, and ultimately when this property is rented, should be collecting about $105,000 per year. The net operating income, so this is really just your gross adjusted income minus the expenses is your net operating income. This does not factor in the cost for the financing. So when you really want to see what you're taking home, you have to add in the mortgage payment. Now here, when we look at the mortgage payment, you can see what the mortgage payment is in the first year when you have the bridge payment, and we have a couple of months where you still have that bridge loan, and then we refinance out of it. And then we have the interest only payment right here. Now, if you did amortizing, you're going to see a slightly higher payment right here, but the cash flow, what you're taking home is the net operating income minus the mortgage payment. So on this property here, with these numbers that we're running here, you would see that we're having about $50,000 a year in cash flow that we're taking home from this property. Now, it's great to know what these numbers are, but these numbers that I've gone through so far don't really mean anything unless you put them into perspective on how good is this return relative to other investments. And that's what the cash on cash return and the cap rate and the gross rent multiplier will do. So when we dive a little bit deeper into this, the cash on cash return simply means the cash flow that you're taking home, how good is that relative to the total investment that you have in the property. And since we now only have $157,000 left in this property, that's good because you don't have a whole lot of money in there and you're getting a really good return on your investment. So the money that you still have in this property is actually earning you over a 30% return, a cash on cash return per year. The first year is very low. It's negative, in fact, because you're not generating enough money relative to what you have in the property. But once you refi out of it and you're getting so much income, then you start generating a very good cash on cash return. Now, cap rate is another way to analyze investments, and it simply means when you capitalize this investment, how good is it doing? So the net operating income, not including the financing, so the net operating income divided by the total cost of the property, so divided by the 896, how good is that number? So in this scenario, we'd be estimating close to a 9% or a little bit higher than a 9% cap rate. A lot of times I see people that are investing in $1 million properties here and getting a 4% cap rate. That's horrible. I mean, right now in 2022, I can go and buy a US Treasury bond right around 4%. It kind of depends on the day and the week and the month. But right now, you can go get a guaranteed bond from the US government at 4%. Why would you want to buy a property at 4%? Because I guarantee you what you will have from that property is you will periodically have tenants calling you and saying, hey, my bathtub is overflowing, my toilet won't flush, the roof is leaking when it rains 2 or 3 days a year here in California. There's going to be maintenance that you're going to have to do on that property, and to get a 4% return just is not very good. So you want to compare. So again, you want to compare everything to the world of investments, not just will this property give me a positive cash flow. You have to look at how all these metrics play into one another. Now, the gross rent multiplier, the best way I can explain this metric is based on how much the property costs and how much you're collecting in income, how long will it take you to get your investment back? And how we figure that out is the total costs divided by the gross rental income. And what this shows you here is that once you have it rented out and all the units built, you should be getting paid back in about 8.5 years. Now, what I did here on this is I made it so that any good investment would start showing in the green. Any kind of moderate or mediocre investment would show orange, and if you really want to stay away from it, it would show red. So that kind of helps you right away know if this is going to be a good investment. As we look a little bit further down here, you can just see different things. The equity of your property growing over time at a 2% estimated growth rate. The loan amount in this scenario is staying constant, and the equity is growing again because the property value is going up. Now, this looks out 10 years. So we can look out 10 years, and in 10 years from 1.1 with 2% growth rate, you can see that we're estimating the property value is going to be 1.28. Still going to have the same loan amount if we're doing interest only, but at this point in time, we have about $540,000 of equity when we started out with $352,000 of equity. So you got $200,000 of equity growth just by holding onto the property, and you're getting that cash flow year in and year out as well. Some other things that this looks at is how much depreciation are we able to write off the property, and all the other things that are estimated tax deductions. This should give you about $45,000 a year in tax deductions. And if we sold the property at 5 years, we would have an internal rate of return of 21%. It looks like the internal rate of return at 10 years would be the same. What internal rate of return measures is the best way to really judge an investment against other investments. Cap rates are good, cash on cash returns are great, but this looks at the total investment from the cash flow, the amount you invested into it, and what you get out after you sold the property. And it looks at that. It looks at how much you had to put into it on day one. It looks at the refi, how much you took back out of it. It looks at all the cash flows throughout the years that you held the property. And then if you sold the property at the value we're estimating it at 5 years or 10 years, what would all those returns be from an internal rate of return point of view? So this is green because 21% return is great. Now let's take a look at this. If this property wasn't $450,000, but let's say we were purchasing it at $800,000. One more zero here. Let's say we were purchasing $800,000. Every other expense was the same. You can see here the numbers are going to change pretty dramatically. Now, when we refi it, we're only taking out $188,000, and we have $540,000 left in the deal. That's going to change our cash on cash returns. We're no longer green here, we're in the orange. Our cap rates now are kind of green, but they're less green than they were. Our gross rent multiplier is now above 10. I like to have 10 and less. If it takes me 12, 13, 14 years to get my money back, that's not as ideal of an investment. And my IRRs now, if I were selling the property at 5 years or 10 years, is 1% and 7%. Now, I didn't change the estimated value of the property. Maybe if I purchased it at 500, build a few units, the value of the property might be a little bit higher. But this just shows you how you can quickly gauge a property on many different metrics and say, does this make sense? relative to the world of other investments. And you can do that here in the high cost of living areas through developing additional units with existing properties. It's really not that complicated. I've done it many times over, and many times over, I'm getting returns just like this. So the opportunities do exist. You just have to go out there and make it. So there you have it, guys. I hope this helped. Remember, you can download this spreadsheet by clicking on the link in the comments below. And don't forget to hit that like button and subscribe to the channel. It'll really help with the YouTube algorithm to help other people like yourself find this content. So take care. I'll see you on the next video.